$9,000. Not too bad, right? That's something that you could save potentially in retirement. Let me explain. When it comes to retirement income, you now, once you're retired, get the ability to choose, most likely, where your income is coming from and when to take it. So, for example, let's say you're retiring early 60s, maybe 60, 61, maybe 62, and you are now needing to spend $100,000 a year, for example. However, you have saved along the way from your 401k, maybe started an IRA, rolled an old 401k into an IRA. Perhaps you saved your company, for instance, Disney, people that work at Disney employees, a lot of them have Disney stock. There was a time where Disney offered the ability to buy in to their stock plan at a discount. And other companies have done that through the years as well. So maybe you've got company stock that is built up over time. Maybe you invested in some mutual funds. A friend of yours told you, hey, you should invest in mutual funds. You weren't really quite sure what a mutual fund was, but hey, you put some money in it just because you knew you needed to save for down the road. And so now you've got these different pots of money in all different sorts of places. Besides the administrative nightmare of that, which we can certainly talk about at another time, this does give you the opportunity to be able to choose how and when to take income to cover your lifestyle expenses. So when we're thinking about saving and planning for retirement income and taking retirement income, you could potentially save $9,000, $10,000, or much more than that by choosing a wise way to take income. So let me walk you through this example. So let's say hypothetically your spouse and you are retired, you're 60, and you need roughly $80,000 a year to live off of. And so that $80,000 a year, you think, well, you're retired, so the first place that you may want to go to take that income is going to be your retirement account, an IRA or a 401k. And so your decision is to go ahead and let's take out, the 80,000, and you could take it out monthly or quarterly or at one time out of your IRA, for example. Now, whenever you took that money out of your IRA, all $80,000 of that money is going to be taxable at ordinary income rates. And so ordinary income rates are going to be just based on your tax bracket. If you're married filing jointly, you look at where that tax bracket ends up. Depending on the year, there's different, those numbers change from time to time. And so you want to add that all up. You have your standard deduction, possibly, maybe you have other deductions that you can take. And, once you do your taxes, you end up having to pay, for example, again, this is just an example. It's not hard and fast numbers, but let's say you end up paying $9,000 that year for taxes, which is just a little over 10% rate on $80,000, which is about where the number is, depending if we're, what year we're talking about, right? And standard deduction and all that stuff. But in essence, let's say you have to pay $9,000 in taxes. Now, you meet with a savvy financial advisor instead, and who looks at your overall financial situation and understands what your goal is. You need $80,000 a year to be able to pay your monthly expenses, go see the kids, go see the grandkids, and hey, of course, go take a vacation or two, right? You want to live, you want to spend some of that money. And so we look at your overall financial situation and realize you do have an IRA, you have 401k as well, but at the same time, you do have this company stock over here, and you have these mutual funds that you've invested in over time. And as you've invested in those over time, you've bought them at different prices. And so whenever you invest after tax, or what's called a non-qualified account, you don't receive any tax benefits for that company stock or for those mutual funds. You have the ability to sell those, even if it's at a gain. The government wants to incentivize investment. And so they incentivize investment by giving tax breaks for capital investment. So whenever you sell an investment that has a gain, it's no longer typically ordinary income if you've held that investment more than 1 year. it is a long-term capital gain if you've held it longer than that 1 year time frame. And so by holding it longer than that 1 year time frame, you now have a more advantageous tax bracket for long-term capital gains, because again, the government wants to incentivize investment. And if we stay within the limit, which is upwards of $80,000 for a married, filing jointly couple, and that number will change over year depending on the year that I'm filming this in 2023, but we're talking about 2022 numbers. And so the year that you're taking it, of course, comes into play. So you want to check the tax rates. But basically, you could sell $80,000 worth of investments to create the cash, because you're not most likely you don't have 100% gains in that. So maybe you have $30,000 of gains or $50,000 of gains potentially, and so it keeps it low enough where you're able to use that money, live off of it, and pay $0 in taxes. So which one would you prefer, paying $9,000 in taxes or paying no dollars in taxes? I think the case is pretty clear on wanting to choose saving the $9,000 if you could. Now, of course, that's not the only thing that we want to consider. We want to consider your overall financial situation. How much income should you be taking? When should you be taking it? How are things invested? What's the current economy like? Do you want to leave an inheritance for your children or grandchildren? And sometimes those factors outweigh just the initial tax savings. But that is an option to consider, and really a great way potentially to be able to retire effectively by choosing what's the right account to pull the income from, and when should you do that to be able to create your account.